Yeah.
Okay. And in your view, beyond just the aspect of the choices that have been made, let's go specific to what has been made in the past regimes.
Yes,
and
yeah.
in particular terms, the Eurobond and the payments that have the payment to the Eurobond and how this will affect us in terms of where we are with the dollar. Just give us a picture, Mwananchi, ailewe where we are.
Where we are, yeah. So as we have talked about so far in the discussion, when we took the Eurobond, we took it in dollar terms, $2 billion. Initially, it was $1.5 billion in June 2014, and then we ongezed like a slice. We call it a tap sale. So there's another 500 million in December 2014. So cumulatively, it was $2 billion. But 2014, the shilling to the dollar was at 87 units. So had the shillings to the dollar been steady over the last 9.5 years, those are the kind of dynamics we could be looking at. We could have paid close to around, it's 7.5 times 2, yeah, that equivalent, around 170 at the higher side to pay off this Eurobond. But right now we are at a situation whereby the shilling to the dollar is closer to 150. So rather than paying this 170 billion shillings equivalent, we are paying 300 billion. So that is something that is coming out to light as a result of the weakness of the shilling to the dollar.
Yeah.
So that's one. So what also normally happens and what is keeping the policymakers awake right now is how do they settle this $2 billion bill that is coming due in the next 9 months, June 2024. So where will they get the $2 billion? So ordinarily, they could go and issue another Eurobond and pay off these investors who are holding the current Eurobond. So that's usually how ordinarily these things work. But right now, they are not able to do that because what you call the kind of interest they'll be able to pay at the international market is quite high. As at the end of last week, this particular Eurobond that is maturing in June 2024, its yield is around 18%. So that means that investors will be demanding something like 18% so that they can be able to give the government a new Eurobond. So that's crazy as it is. So the government said that they will want to do a buyback.
Okay.
So we have $2 billion, and then they want to do a buyback in the sense of, it's just the way if you have a loan in the bank, and then you have a business or some consultancy, and then you get some big money, and then you say, okay, for this loan that I have, I want to say, at least reduce it by a half.
Yes.
So that's similar thinking within the buyback that the government wants to do.
Able to.
That's now the other question. So they're looking at our FX reserves. So our FX reserves as at the end of last week was around $7 billion, give or take.
Okay.
So the thinking is that they can get that even $1 billion between December. That's none other than the president said that they would do a buyback by December. Take $1 billion from the FX reserves, and then they pay off. They can do that. And then come June next year, rather than having $2 billion, they just have $1 billion, and then they can go around it. But now what you heard of late is that even the government, rather than doing that buyback, it says that it will not do it. It will wait till June next year, hoping that the FX reserves will be around $7 billion, give or take, because I know there's some netting off, there's some debt that needs to be paid in between. And then they remove $2 billion from the FX reserves and pay off because they can't go to the market and issue another Eurobond. The rates are quite crazy. So that's the thinking that they want to draw down from the FX reserves. And then what will that mean? Okay, June comes, probably they're not able to do that, and then they're removing 2 billion from the FX reserves, it drops to around $5 billion. So the risk going forward will be, probably there'll not be another external shock, or there'll not be another internal shock that will lead to further decline of the FX reserves, because those are some of the indicators that people will look like. And if you look at even countries which have defaulted, countries such as Ghana, Sri Lanka. So more so the case for Sri Lanka,
Yes.
it had like $1.1 billion of FX reserves. That is April last year, March, April last year. And in terms of, because now we look at this FX reserves, and then we look at it in terms of months of import cover, because months of import cover is a good metric as to how adequate the FX reserves, because you need, it's just an adequate measure. So it wasn't adequate for Sri Lanka. Just having 1.1 months of import cover, and then you have this staggering external debt that you have to pay from your FX reserves. So that's, defaulting was the path of least resistance for such countries such as Sri Lanka, similar to Ghana. So in my view, right now, probably that risk might not be heightened now up until June, but after June, that will be a bigger risk, because our FX reserves will have come lower to $5 billion, which might be around 2.3 months of import cover. So anything can happen. Rather than the statutory 4 months of import cover, it has come lower to 2.3 months of import cover, and that's where the risk will be, even on the shilling going forward after that event.
And so there's no option of buyback, and there's no option of issuing another Eurobond to offset this one. Then we're looking at our FX reserve, and if things don't look good, a default.
Yes, like in my scenarios, I'm looking at the drawdown of the FX reserves as the last line of defense.
Okay.
So if you're not even able to do that, I mean, we are not able to do a buyback, we're not able to go to the markets as it is, and then we are not able to draw down our FX reserves for one reason or another. I mean, now it will be a default. So if we're not able to do this worst case scenario, drawing down from our FX reserves, now default will be now the next unfortunate thing to do.
A very, very dark outlook we have, but if any, is there half-full scenario to this situation where is there any form of looking at it advantageously, that is a weaker shilling or weakening shilling, because yes, we're a net importer, but for an exporter or in any other scenario within the market, can this be seen as anything advantageous, the weakening shilling?
Well, for the exporters, they are able to take advantage of the current environment as it is. So it means that if they are importing, or definitely they get their income in hard currency.
Yes.
By hard currency, this is dollars.
Yes.
So the fact that the shilling has weakened by this much, it means that if you flip it around, the dollar has also appreciated against the shilling by slightly higher amount. So it will be advantageous to the exporters. So it now goes back to the government. What plans are they doing so that they can be able to ensure that exports become vibrant, even in the next 2 years or 3 years? So that is the missing link. And I keep asking myself, I keep wondering this billion-dollar question that I keep asking, what plans do the new government have? Okay, we've had things around the Hustler Fund, we've had things around this digital superhighway, we've had things around the agriculture and all that from their manifesto.
Yes.
But remember, we need to look at the bigger picture. The bigger picture is Vision 2030. And in any given year, we are within a medium-term plan. So the first medium-term plan started from 2008 to 2012. And the focus around that was basically the Constitution, which came out in 2010. And then the second medium-term plan started from 2013 to 2017. And that's where I think they were quite heavy on devolution and all that. Obviously, there are other things, but devolution stood out for me during that second medium-term plan. The third medium-term plan was 2018 to 2022, and that was where Big Four agenda came in. Obviously, the other things, but Big Four agenda came in. But right now, we are 1 year after the new regime came into place. We don't know what the fourth medium-term plan looks like, essentially from 2023 to 2027. So having said that, those are some of the mechanics, or that's where the policy thrust as to see what is the export policy for the government. So that's how they can be able to take advantage of the weakening of the shillings, as they can now be able to boost their exports.